Hope everyone is doing well. Give me just a few seconds here. Had a slight delay with a computer. Again, it seems like every day I become a little bit more of a believer in HP's computers. And I guess it's just kind of bad luck with the Microsoft laptop I have. And I've normally liked it's a Surface laptop, and I've normally had pretty good luck with them, but for whatever reason, it seems like there's a little bit of issues each and every day. Let me just check one thing here. And fix this. There we go. So overall, it's interesting. I'm curious in the comments, can everyone see a red circle? Or in other words, around the mouse? And while for whatever reason it shows it on my screen, but I cannot see it on the StreamYard screen. Interesting. Okay, I'm going to try and fix that really quick. Give me just 2 seconds here. So I'm going to try and turn off this application. I was hoping, it's called Pointer Focus. I was hoping it would work, but it does not look like it's going to. So I'm going to change the mouse settings. Go ahead and feel free to ask questions. And because of some of the delays, I'm going to extend this discussion. So I'm going to turn off the screen, and then I'm going to share my screen once again. Hopefully that will fix the pointer. My hope is the pointer's green, and that will at least be better than nothing. So overall, let's get started with today. On the daily chart, we can see that the market, we're in a trading range here, and we gapped up, or we didn't gap up. We broke out to the upside on May the 17th and May the 16th and the 17th. And it was a strong enough breakout for a second leg. However, it was also a breakout of a triangle within an overall large trading range. And whenever you get a breakout of a triangle within a trading range, you always have to wonder if it's wrong. In other words, the breakout's going to fail. And the bears, you can see they got a bear bar here and then a doji bar. And that doji was pretty much a high one buy. High one buys typically in a strong breakout lead to a second leg. But when you get a breakout within a trading range, you always have to wonder if it's in the wrong direction. And we can see the market broke to the downside yesterday. This bar yesterday, which was the 23rd, it trapped traders into the wrong direction. So bulls got trapped, which increased the probability that the market would go lower. And you can see, why did we bounce? Well, we reached several targets. The low of the first bull bar, May the 17th, and then we reached the low of May the 16th, and we found buyers down here. So bulls bought and the market bounced. But overall, strong enough breakout, probably going to go sideways. Now you had bulls trapped up here, and you did have some bulls give up. But what we don't know is, are those bulls going to scale? There's going to be bulls that bought and scaled in, and 80% chance the bulls buying up here and scaling in lower are going to be able to get out break even. So strong breakout, yes. Second leg down, likely, yes, but probably a deep pullback first. So I think we're probably going to try and bounce. And the end of the day is probably the start of that bounce, but I suspect the first reversal up will be limited. This is the May 16th low, by the way. Let me make an adjustment here. This is on my trading computer, so some of the text and whatnot are a little bit smaller. So here's the open of the day. And on the open, the market gaps down. And it's a pretty big gap. We had a strong enough breakout yesterday. I thought we would get at least go a little bit lower. But on the open, my one thought was that the market would have at least 2 hours of trading range price action on the open. So here's the gap. Bar 1, it's a bear bar, and pretty big tail below bar 1. Is it buy the close, sell the close? I don't know. There's probably buyers below 1, but gap down, we could easily get a second leg. In other words, maybe 50-50 chance we get a small trend from the open and test lower. We've also got the target below the May 16th low right here. And that is this blue line down here. Bar 2 is an inside bar. Is it sell the close? It might be. Some bears will sell below 2, but it's an inside bar and probably going to go a little bit lower. And if you're selling because you're betting on a trend from the open. What about buying below 2? I would not. While the market could reverse up, consecutive bear bars probably going to go at least a little bit lower. Make this screen a little bit more narrow. Three consecutive bear bars. Is it sell to close? It might be. My concern is, you can argue it's sell to close, but my concern is we're far from the moving average. And typically on the open, 50% chance that the market will reverse whatever initial move you get. It'll be a major reversal. 80% chance there's a minor reversal. Four consecutive bear bars it is sell to close, probably going to go a little bit lower, but far from the moving average. And if we start to go sideways, we will have bears buy back shorts and bulls start to buy. 5, another consecutive bear bar. 5-bar micro channel, consecutive bear bars closing on their lows. Probably going to go a little bit lower, but becoming climactic. And then 6, we have a bull bar. Traders that sold the close of 5, what do they do on 6? I suspect they're disappointed. So you'll have some traders trying to get out break even at the close of 5. However, the reality is 6 is not enough to reverse the 5 consecutive bear bars. So probably sellers above scaling in higher. 7, a bear bar, but 6 is a warning. We've been in a sell to close market since bar 2, maybe bar 3. And whenever you get a doji like bar 6, that increases the probability that the market is going to bounce soon. So traders sell the close of 3, they sell the close of 4, they sell the close of 5. And then when they see 6, it's a warning. And it's a warning that the market, while 6 may not fail, 6 is not probably going to lead to a reversal up. It will probably come back to this price level. So this red line will be a magnet. And you can see a few bars later, it tested it. And what I mean by magnet is anywhere in this bar, the middle of the bar, somewhere in here, this was buying pressure. So really the magnet, I guess you could argue, would be the midpoint of the bar. But anyways, 7, still sell the close, but whenever you see a bar like 6, it's better to start probably buying back shorts. And then 8, another consecutive bear bar, possible parabolic wedge, 1, 5, and 8, but tight bear channel. Probably any reversal will be minor. Obviously, we're vacuuming down to the May 16th low, this red line right here. Bar 9, reversal, testing the breakout point of the 6th low, but micro channel since the open, so probably sellers somewhere above 9. So low probability buy. And then 10, we have a bear reversal bar. You can see traders sold above 8, they scaled in higher. Probably buyers below 10 scaling in lower, but we could easily go somewhere down here. And then 11, pretty big bear bar. Is it sell to close? I would not. To me, whenever you see a sell off on the open that looks like this, especially one that's a little bit climactic and you start to see buying pressure, it's reasonable that the market's going to go sideways. Whenever you have a gap down, you always expect a second leg. So we have a gap down, which is a breakout. We expect a second leg, and maybe this is the start of that second leg. But the other thing you expect is whenever you have every day, there's a 99% chance you're going to test the moving average. The moving average is all the way up here. So you have to ask yourself, if the moving average is 15 points away, what's the probability that the market's going to continue to go lower without getting closer to the moving average? It's low. And if it's low, you know the market's going to pull back and get closer to the moving average. 12, we have an inside bar. Reasonable for bears to exit. First reversal up is still probably going to be minor, but if you're a bear, it's reasonable to exit above 12 because the reversal could be deep. It could be all the way up here to the moving average. 13, consecutive bull bars, testing the high close of 9. Good for the bulls, but still probably always in short, and the first reversal up is going to be minor. And then 14, a doji. 3 consecutive bull bars, although 14 is a doji, probably buyers below 14, scaling in lower. And then 15, an outside bar, still probably going to go sideways. 17, testing lower, trying to break out below 15, probably buyers somewhere below 16 or below the day, bar 12. If you're a bear and you sold the close of 11 and you scaled in higher, you're probably disappointed enough that you're going to look to get out break even. $17, test of the low of the day and the 11 close. Probably buyers down here more than sellers. As I said earlier, if you're a bear and you sold this close and you scaled in, you're disappointed. You sold down here hoping that this was going to lead to resumption down, and instead the market reversed. If the market reverses, that means you sold in an area that was support. So what are you going to do on a retest? You're probably going to buy back shorts. Now 18 is a reversal up, but it's following consecutive bear bars. Do you really want to buy above 18 for double bottom? You can argue it's a truncated wedge. Actually, it's a wedge. 8, 11, and 17. A truncated wedge is where the final leg in the wedge, in other words, the third leg, is a double bottom or a higher low compared to the second, but this went a little bit below and reversed up. But 18 is not a strong enough signal bar compared to these two bars. Now 18, it's blue and it signifies the 18 bar range. So 90% chance we're going to break below 17, the low of 17, or break above the high of 1. Obviously, we're really close to the low of 17. So we're probably going to go below the low of 17. And we did. We went down and we turned up. 19 is a bull reversal bar. Second leg down from 17. It broke below the 18 bar range and it met the minimum. Now, whenever you have a breakout of the 18 bar range that is only a few bars, 1 or 2 bars, and then it reverses up, that increases the risk that it's a failed breakout of the 18-bar range and that the market will try and get to the open of the day. Now, obviously, we're far away from the open of the day. Therefore, it's still, any upside is probably limited. For the bears, for the bulls, they have a major trend reversal. We have a bear trend line break, and then another trend line break to 15, and then a new low to 19, but it's minor. We went up for 3 or 4 bars. We went down for 3 or 4 bars. That is probably not enough. And what that means is we need a better looking major trend reversal. We have a bear trend. So here's a trend line. The market needs to break far above the trend line. Then we'll have the formula for the start of a major trend reversal. But even then, if we get a strong upside breakout, we could get a pullback all the way to a new low, which is what happened today. Most major trend reversals lead to minor reversals. And what that means is most major trend reversals are not good enough. 21 is a doji after 20, so it's weak. Follow weak entry bar after the 19 bull bar, and 19 is not all that great of a buy. It's a doji bar. It's a small body compared to the tail, and probably more sellers above than buyers, but it's low in the range, and that's reason enough for bears to exit. 22, a failed breakout of the 21 high. We broke above the 21 high, but we couldn't close above it. Micro channel since 19, so good for the bulls. And then 23, we have a strong bull breakout above the moving average. Are we always in long? We might be, but in a trading range, this is a bear trend. We have a bear channel. We went sideways. Most bear trends evolve into trading ranges and not opposite trends. And when the market evolves into a trading range, typically when it becomes clearly always in long, it usually starts to go sideways and reverses. And when you see a bar like 20, when you see this bar, you never know at the time how many traders are waiting to sell. So strong breakout, yes. A lot of traders, are they going to sell the close? Probably not. They're probably going to wait for follow through. But the risk, if you're a bull and you're buying up here, is it's a 50% pullback for the bears. And let's rewind a minute. Where did the bulls get trapped? Well, arguably the bulls got trapped behind the one low or the low of 2. It was reasonable to buy in this area. We have a doji bar. We have buying pressure on the low of 1, probably buyers below 1 scaling in lower. But if you bought below 1 and scaled in lower, you got trapped on 3 and then 4. So if you're a bull and you bought and you scaled in all the way down here, what are you going to do if the market tests your entry price on your first entry? You're probably going to exit. And that's what happened. The market rallied up to 24 and immediately sold off. Why? Because you had trapped traders. So 24 is a reversal bar. It's a micro channel since 17. So it's a 7-bar bull micro channel. Actually, it's a 6-bar bull micro channel. Probably buyers below 24, but you're at the moving average, and that is resistance. We've been away from the moving average all day. And the first touch of the moving average will probably bring sellers. 25 closed below 24, so we triggered the sell below 24. Probably buyers below 24 scaling in lower, but look what happened at the high of 25. If you're a bull and you bought the close of 23, this bull bar right here, it is at 29.5. The high of this bar is 29.5, which means the bulls that bought the high close of 23, it retested. They were disappointed on 24 and they got out break even at the high of 25. 26, we have 3 consecutive bear bars. It's a high one buy, but high one buy at the top of the trading range. The bulls probably will get a second leg up after the rally up to 24. This is a strong enough rally, probably buyers below scaling and lower. But the one problem that the bulls have is that there's probably going to be buyers somewhere down here, but we don't know where. And the buyers they may come in at the 17 low or the 19 low, which means if you're a bull and you're buying and scaling in lower, the market may have to get all the way down here before the market finds buyers. 27, bulls giving up, bears selling aggressively, but trading range day, when the market becomes always in short, usually it reverses rather quickly. So big bear bar, yes, but a big tail, and it's a possible second leg trap. It doesn't look like a second leg trap, but it's implied. We sold off to 26, we pulled back, and then we sold off sharply on 27. That is 2 legs down. It's also a two-legged trap on a larger perspective. The market sold off down to 12, it pulled back to 24, and it got a second leg down to 27. And then 28 reversed up. Some of the bulls, they bought the 24 low, they bought the 25 low, they even bought the 26 low, and they scaled in lower. And they're disappointed with 27. So what are they going to do? They are going to look to buy. They're going to look to exit their longs around their entry price. That means that as strong as 28 appears to be, it might be more due to bulls buying and looking to exit around where they got trapped. And the bears know that, so the bears may sell as well. What I think is going to happen at this point is we have a strong enough rally and we have a strong sell-off. It was reasonable, even though it was pretty extreme and at resistance, it was reasonable to buy the 23 close, which means probably buyers up here. And if bulls do something reasonable and they buy and they scale in lower, the market will probably allow them out of the trade, which means we're probably going to get up here. However, if you're a bull and you bought the 23 close, where's a reasonable stop? One, and I use the word reasonable. What I mean by that is not the best stop, but an okay stop. And trading ranges love to test the okay stop locations and stop traders out. It's skunk stops. So one was if you buy the 23 close, but you stop below 23, that got hit. Another one, the 22 close, that got hit. So where's the next target? Obviously, it is the 19 close. So if you're a bull in a trading range, do you really want to buy the close of 23? If you think the market could be in a trading range, do you really want to buy the close of 23 and then buy more at the low of 19? Let me back up. Do you really want to buy the close of 23 and then put your stop below 19, one tick below? Of course not. Because if you're a bear, you're looking at this and saying, well, I don't want to sell at the 19 low. There's probably buyers below 19. And you're right. So in a trading range, it's always gunning for obvious stop locations, which means I think we're going to try and fall below the 19 low before we reverse up. Because why? Because that's what trading ranges do. Trading ranges try and make things difficult, and they try and trap traders out of trades. So you look right here. You sell down here, put your stop up here, you get stopped out, and then the market goes down. You sell here, or you sell the moving average, and you get shaken out by this bar, only for the market to reverse back down. Now, 28 is a bear bar, and some bears, they were disappointed with 20. Well, 28 is a bull bar. 29 is a bear bar. Some bears sold the close of 27, hoping that we would get a downside breakout similar to yesterday's 48. So we have a sell-off, we have a rally, but what's the difference here? This rally failed to close above the moving average here. This rally broke a decent amount above the moving average, so it's a stronger breakout. It's a stronger penetration of support, which means that it's a stronger penetration of resistance. And because of that, that will increase the probability that the market is in a trading range and not in a bear trend, which means probably more buyers below. 30, testing the close of 27, and then you can see we reversed up. So there was buying back at the 27 close. Let me open one thing really quick here. And 31, we have a bull bar. It's a double top with 28 and 31, testing the highs of 29, but it's right at the moving average. What about buying the high of 31? You can, but we had a strong enough sell off from 24 to 27 that the bears may need a second leg down, which means it's possible the 31, the current bar, it's possible that 31 is more of a reversal. Excuse me, it's possible 31 is a bear flag, a two-legged pullback, and the bears will get a second leg down. So strong enough sell off, two-legged pullback, we may have to get a small second leg down before we get a second leg up. But I do think we're going to try and get to the magenta line, the 23 close. So now we have a low two short with 32. Is it buy the close, sell the close? Probably buyers below 32, but low two short, strong sell off, probably at least a small second leg down. And that's what 33 was. 33 tested the low of 27 and reversed up. Now, if you're a bull and you bought the low of 32, how are you feeling about your entry bar 33? You're disappointed. Why would you be disappointed if 33 is a big tail below? Well, you're disappointed because if you bought this low and you scaled in lower, you bought the low hoping that the market would go up quickly and allow you out. So you bought the low of 22, maybe you put your target 3 points higher. So you put it at 25 even, which would be one tick under the high of 32. And instead, the market went quite a few points down lower. So if you bought here and then scaled in, you're probably thinking, gee, the breakout on 33 below 32 is disappointing enough that maybe I should buy back my shorts at the low. Maybe I should sell out of longs at the low of 32, this bar right here. And because of that, that's what led to this. So 33 pulled back, and it was a pullback more so than a reversal attempt. 34, bear breakout below 27 and the 19 low. So the bears did the minimum. They went below obvious stop locations in a trading range. And 25 is a bear bar. So are we always in short? Well, we have a 4-bar micro channel. We have a gap, the low of 32, high of 34. And you can argue we're always in short. But what have I been saying about always in a trading range? The market becomes always in, let's say long, right before the market reverses to short. And the market becomes always in short right before the market reverses back to long. In other words, you see a surge of momentum. However, the surge of momentum is usually more due to a vacuum. And then we have 36. When you look at 35, when I was watching this, I thought this was going to lead to a failed breakout of a trading range. And when you're looking at it, if you're long here, you're thinking, it's kind of scary. We may get the downside breakout. But you look at 35 and you think, yeah, it couldn't even close below 34. I don't know. I think the bears need one more bar. And then 36 is a doji bar. It's an inside bar. It's a bear bar closing on its low. So it's a low one short, but it's a very small body compared to the tail, which increases the risk of more buyers below 36 than sellers. And then you can see 37 reversed up. So 37 is a micro double bottom, lower high, major trend reversal. We had a bear trend line break, and then a lower low, I said lower high, I meant lower low, major trend reversal, bear trend line break to a new low. And the new low subdivided into two legs, good for the bulls. Always in traders exit above 37. Why would they exit above 37? Because we have targets above. We have the low of 32. It was reasonable to buy the 32 low if you could use a wide stop and scale in. And the bulls that bought the 32 low and more lower never had a chance to get out at their first entry, the 32 low, which means we're probably going to go back to the 32 low. The next target is the high of bar 23. It was a strong enough breakout above the moving average. It should have had a second leg, and it failed. I want to make a note of one thing really, really quick. There we go. So always in bears, I would get out above 37 because it's reasonable for bulls to buy. Decent entry bar on 38. Are we always in long? I think so, but the bulls ideally need to break above the moving average. And then we have a tail on 39. Now, if you buy the close of 23, this close, it's reasonable, and then you buy more above a bull bar, there's an 80% chance that you can get out break even on the entire trade. You buy here, you buy more above a bull bar down here. 80% chance we're going to hit this line and allow the traders out break even, which means on the other side of that, there's a 60% chance that the market is going to get back to the original entry price on bar 23. I think it's higher probability than that. But when I say 60% chance, it's 60% chance we get there. It's not necessarily 60% chance that we do not fall below 37 before we get there. 39, low one short, but to me, the bulls are just getting too much buying pressure. And this is probably a leg down in a trading range it's a channel, but it's probably forming a trading range, which means the bulls are probably going to get the upside breakout and test somewhere in this area. 40-second leg up, but it's a high one, but 40 is a high one, and 42 is the start of a second leg up. But 40, this doji, is a bad stop entry buy. So there might be more sellers up here. I still think strong enough breakout, 2-bar breakout, that we're going to go above 39. 39 is a bad low one short, which means probably buyers below 39. And when you have a bad low one, typically the market will go to the high of the bar before it goes and measure move down. So if you're a bull and you buy the low of 39 and you put a target up here, it should go up to your target before it goes 1 times the risk down. In other words, you should be able to make 1 times your initial risk on the trade before. So you buy here, you set a stock target up here, and then you put a stop, a measured move down. 42 is a bull bar. Still need to break above the moving average, and then we reverse down. So some bears, they sold during 39. They scaled in above 41, and they're getting out break even. The market's testing the high of 36, high of 37. 36 is technically the stop entry buy, although most traders would wait and buy above a bar like 37. What that means is 36 is a bad stop entry buy above the bar. So there's probably more sellers above 36 than buyers. And you can see the high of 36 is 1725. The low of this bar is 1725. Trading ranges are very forgiving if you sell anywhere. In other words, if you bet on breakout points failing, so you buy the low of here, 32, this bar, and you scale in lower, you're probably going to be able to make money. And you can see the market rallied back to the 32 low during 39 and 42 and allowed those bulls to make money. And the bears know that, so the bears will sell up here. It's the same thing down here. A bear that sold the 36 high or the 37 high, they got trapped during 40. They got trapped during 38 and 39. And because of that, they are going to be disappointed. And what they're going to do is probably buy back shorts on any retest of the 36 or 37 high. And the bulls know that. The bulls aren't dumb. So what are the bulls going to do? The bulls are going to buy back. The bulls are going to buy to go long for a scalp around the 36 and the 37 high. And they also know that there's an obvious target above the break-even price, which is this line right here, which is pretty much around 21.24. Big bear bar on 45. And is it going to break below the low of the range? Probably not. It's a retest of the low of 36. Some bears sold below 36, betting bear trend. And the reality is, if you sold below 36 and you sold more higher, you're sufficiently disappointed with the rally on up to 42 that a lot of traders will probably look to buy down here. Bulls will buy to go long, and bears will buy to buy back shorts. It's also a wedge. 11, 35, and then down here. But the shape of the pattern is bad. And then 46 is a strong bull reversal bar. Strong enough reversal, probably going to go higher. I still think we're going to get to the 23 close. Now, at this point, it's getting rather late. It's about 40 minutes until the FOMC report. And it's pretty common for the market to have a swing trade set up about an hour before the FOMC is released and try and get you to be long or be in the market when you probably shouldn't. So most traders, I would let this go. But either way, strong enough bar on 46, probably at least going higher. So bulls will buy above 46. And look what happened. The market rallied to around 41.25, 41.24 and sold off. But the rally up to 45, up to 46 and 47 is strong enough for at least a second leg up. And 48 is a low one short. You can call it a double top or two legs up with 42 and 47, 42, 47, but probably buyers below 47 scaling in lower. Some bears, they sold the high 45 here, and they were disappointed with 46, and they said, maybe I should just get out, break even at the 45 high, and it never let them. So they would sell here. They'd probably scale in more up here, and look what happened. The market tested the 45 high right here at 19 even. And it went one tick below it and turned up. Strong enough breakout 46, 47. I said there's probably a second leg up, and this is probably the start of that second leg. Now, again, I still think we're going to get to the 23 close. We're probably going to go at least one tick above the 47 high. 49, 50 consecutive bull bars. We tested the 24 low, the first target. Some bulls buy the 24 low. Disappointed 25. They tried to get out. They did have a chance to get out on 26 or 27. So it doesn't necessarily need to be tested that much because a lot of bulls that bought the 24 low, they would be disappointed with the entry bar 25, that a lot of them would get out break even here or here. But if they didn't, some of them got out break even on the entire trade here. Others scaled in, and now it's allowing them out. So we may pull back a little bit, but I still think the magenta line is the target. And we have 3 consecutive bull bars, 49, 50, 51, but not a good area to be buying. There's 3 bars left until the FOMC report, and you're right at resistance, the close of 53 and the high of 50, the close of 23 and the high of 24. So probably resistance in this area. And then you can see what happened. Bears took profits. Bears started selling. Bulls took profits. Outside down, 52. Do you sell below it? I would not. I think probably going to pull back here. Yes, I think we're going to pull back here. But my problem is tight bull channel, lots of bull bars. We could easily get all the way up to the 24 high. Some bulls bought the close on 51, disappointed 52, and they're using 53 to sell out of longs. Bulls buy the close at 51, scaling lower 52. They get out break even at their first entry. 54 is another inside bar. At this point, pretty much breakout mode. I would wait for the report to be released. And then 55 is the report bar. Outside down, big outside down bar. Enough of a surprise, probably at least a second leg down, likely. But it's a big bar, which means probably going to pull back first. Bulls bought the 54 low or the 53 low. They got trapped. So you know there's bulls buying the 53 low or the 54 low, scaling in, and the market may have to test these lows before it goes down lower. And that's what happened. Bulls buy here, they scale in because they got trapped, and they will sell back at these lows, which means there's probably sellers up here. And one other argument you can make is if you're a bull and you bought the close of 55, thinking 55 is a big outside down bar, it's probably not going to go straight down. If you bought this close and then the market starts to go straight up, what are you going to do? Are you going to look at 55? Are you going to look at this bar? This 1.56 was a bull bar closing on its high. And it's probably early in the bar. And if you think about it, a lot of traders, when they take a limit order trade, like buying the close of a bear bar, if they can get 2 or 3 or 4 points, they'll scalp out because they know that in the final minutes of the bar, it could sell off and be a bear bar, especially when it's testing resistance like the 54 low or the 53 low. And the market went down a little bit lower, and it tested the May 17th low, May 16th low. This blue line tested the 49 low over here. But the reality is bulls buying here and scaling in are going to make money. You'll have some bulls who look at 54, they look at 55 and they say, that's just too strong of a bar to buy. I'm not going to be a buyer at the 55 close. I want to see buying pressure first. And then they see 56. The market rallied and sold off, and they'll say 56 is a bear bar, yes, but it had a lot of buying pressure, has a pretty big tail on top. So on a smaller time frame, it's a bull bar. It rallied and pulled back. So you will have some bulls buying below these lows, betting that it will lead to a second leg up. So we had a leg one, a pullback that went below these lows, and then a second leg up, which is in part why some traders buy. Other traders, they will use this rally on 57 to exit here. So there's many, what that means is you're in the middle of a trading range and there's many decisions to make. If you're buying above 57, which I don't think it's ideal, but if a trader does, it's probably better if they can buy more below 57 and put a stop somewhere down here, which means not really that ideal. Strong enough breakout 55, 56. Probably a second leg down, likely. And then 58, low one short, but tail below, probably buyers below. And you can see some bulls buy above 57, they buy more lower, and some of them getting out break even. 59, stop entry, but a weak body compared to the tail, so there might be more sellers above than buyers. 60, breakout below this double bottom and these bars over here. Is this breakout 60 going to lead to a strong sell-off? It might, but when you look at it, it's also a third leg down. First sell-off to 52, second leg sell-off down to 57, third sell-off down to 60. So leg one, leg two, leg three. Or you can say first leg was 55, pull back, second leg 57, third leg 60. Then we have a bull bar on 61. A lot of traders, for me, if I was short, I would get out of longs. I'd get out of shorts above 61 because bulls are probably going to buy. Obvious targets above, you have the high of 59, high of 57, and somewhere up here. So 3 legs down, fail break, or you could say fail breakout below a wedge. Either way, probably buyers here. and 62, bears giving up. Good bar for the bulls. If you're a bear and you sold the 61 high or the 60 high, you got trapped on 62. So if the market goes straight up, it'll trap bears further. And you can see it pulled back a little, but did not pull back all that much. And then 64, we have a bear bar. To me, if you're a bull and you bought the 61 high and you scaled in, if you bought the 61 high or up here, and then you see 63, I think a lot of traders, when they see 63, they'll conclude we're still in a trading range. And they bought because the momentum was strong. So they bought 62 because it was a big bull bar. And then 63 was hesitation. So what are those bulls going to do? A lot of bulls will start to sell or at least lighten their position so they can buy more lower. And that's what happened on 64. 64, bear bar, double top with 58. We have an open gap, the 61 high and the 63 low. And we have an open gap in a trading range, which means the gap's probably going to close, which means I think we're going to fall. I think we're going to go at least to one tick below the high of 61. So in other words, if the high of 61 is 4120.25, I think the market's going to try and fall to 4120. And it went below it. And then you can see it pulled back a little bit further, testing the low close of 60. But now the bears have an open gap. They have a low one short on 64 or a double top. You can call it a low two with 58. So the bulls, some bulls bought the low of 64 and scaled in lower. And you can see, just like the bears that sold the high of 61 and scaled in higher, these bulls are trapped. So what do you think is going to happen? The market's probably going to get back to the 64 low and allow those scaling bulls out at their first entry. 66 is a warning that the market's probably not going to go all that much lower. It's kind of like the opposite of 63. And then the bears got a second leg down on 67. But probably buyers in this area more than sellers. But we could easily fall below the 61 low before the market reverses up. And then 68, we have a bull bar testing the high of 64. You could argue the channel down to 60 was tight enough that the first reversal up would fail, and that is the retest of the lows. So you can argue 67 or 68 is a double bottom major trend reversal. But either way, enough of a surprise. We're probably going to go a little bit higher. And then we have a strong entry bar on 69. And the bulls are getting a lot of buying pressure here. So you have to wonder if we're going to try and get the upside breakout. And there obviously was the upside breakout, 70. 70 is a big enough bar, closing far above 52. And it's a little bit climactic, but we could easily get up to the open of the day. So if anything, you're buying up here, stop somewhere down here. Decent. Another bar on 71, but it's a decent bar on 71, but it's got a tail and lots of trading range price action up here. I think we're going to get to the open of the day, probably go above it. But the reality is the bears that sold here or here are probably going to make money. 72, possible second leg trap, but weak. Stop entry short below 72, so probably buyers below. And you can see the bulls got another leg up, but it's an inside bar. Whenever you get an inside bar in the trading range after a breakout, you have to wonder if the market's going to come back to it. And then you can see all the bears that sold 24, that sold the 55 high, the 52 high, or the open of the day made money. And then we pretty much went sideways in the close. So we had a second leg trap. Leg one, pull back. Leg two. Let me just make a note. As I talk through the market, I have my computer pulled up on PowerPoint, and I've got a screenshot of today. And I will make quick notes like a second leg trap, leg one, pull back, leg two. late test of the open of the day, just kind of various things like that. I find that to be helpful with just further studying price action. For stop entries, really let's go over always in. For always in, and by the way, I'm going to talk more and more about always in. I'm trying to think through, more things to add with that daily, but I will talk more about it soon. Always in, probably always in short on the close of 3, so reasonable to sell. Close of 3, some traders sell below 2, but in general, I'd rather see 2 bars closing on the midpoints with at least 1 closing on their lows. So that'd probably be the close of 3. And bulls, where do bears get out? They probably get out above any bar at this point, certainly a couple points above a bear bar or above a bull bar. And then I think it's okay to get out of longs above that bar 9 or get out of shorts above 9. As far as buying, I would not. And if a bull buys there, what do? I don't know. They probably get out break even in here. And I think it's okay to buy above 19, stop below, a little bit aggressive though. And it's a minor reversal. So if you're buying, you get out below a bear bar. So if you bought here, bears definitely get out of shorts. Some bears would sell again here. They definitely get out of shorts here. Bulls buy, and they can buy above this bar. But then what do they do below 24? Some might hold, but when you see 25 and then 26, I think you have to exit the trade. Too much risk of a sell-off down here. 27, back to always in short, but as I said, trading range, so it makes it dangerous selling there. And then 28, we have a bull bar. So to me, I don't know. I'd probably be flat at this point. I think if you did sell, it's okay to get out of longs above the bar, or you get out above this bar. But then what do you do here? Maybe you have to sell again, and bears get out above here, bulls buy, and tough calling here. If you don't get out there, you probably just trust your stop. And in this case, you wouldn't have gotten stopped out, but you'd have to hold through a pullback that just about stopped you out. And then pretty much you get out anywhere over here with the FOMC coming up. I'd probably get out above this bar or below it as this bar triggered. And bulls, what do? Some might buy above this bar, but it didn't trigger. Others, do they buy above here? I think they can. And if they get, and you can see decent follow through, but then there, probably buyers below. And again, same thing. What do you do here? Do you hold through a pullback that just about stops you out? Not really that easy, but then bulls buy and they get out, anywhere in here. But that's really, that's all always in a trading range is very difficult. And most traders, if you can read a chart well, you're not going to trade always in a trading range because you're going to give up so much profit. It doesn't make sense. You're going to instead trade with limit orders. So as the market's going down, you're going to buy and scalp out. Big bear bar, and bulls are trapped here. You're going to sell up here for a second leg down. Doji, you're going to buy below here and scalp out. Bull bar, your bear bar, if you buy it and scale in, you're probably going to try and get out break even. And because of that, bears are probably going to try and sell the close here for a second leg down. Low one short, bulls are going to buy. So various things like that. With that said, limit orders, probably sellers. Not easy, but probably sellers above 8. Sellers on the close of 9 for a second leg down, but probably buyers below 10. Sellers above anywhere in here, but hard to do. And then buyers below bull bars like a 13 or these doji bars. Probably buyers below 18. Sellers above bars like 15 or 10. Sellers at the moving average scaling in. Buyers below 24, but if they didn't get out on 25, 26, or 27, they got trapped as 27, went below 26, and then buyers below 29, buyers below 36, probably sellers up here in this area, testing the 32 low right here. Buyers below 44, buyers below 43, scaling in lower. Buyers below 47 for a second leg up. High one buy at the top of a trading range. So 54 testing over here, probably sellers above. But right at the FOMC, I would not be trading in this. Bulls, probably buyers below 56. And maybe sellers above 57, but I think that's pretty hard to do. But strong enough bear bar 55, 56, probably sellers above for a second leg down. And 60 breaking below 48. So probably buyers in that area. And, same thing in here. Bull bar, we rallied all the way up, but then we started stalling. So traders bet on this gap closing above 61. 64, we have a stop and true short, bear breakout below 65. But then 66, the momentum starts to dry and it starts to weaken. So traders are going to bet that the low of 64 starts to close as well. Then we got a strong rally, probably buyers below 72, buyers below 73, but that is so late in the day, I'd let it go because you can easily face that. And bears selling above 55, above 52, above 24, selling at the open of the day. Buy the close, sell the close. Probably sell the close 3, 4, and 5, and even sell the close of 6. But 6, I talked about being a warning that bears would probably buy back short soon. And what about 9? Is it buy the close or sell the close? I don't know. It's probably more sell the close, but you could easily get a deeper pullback than you want. So I think it's hard to sell the close of 9. And then 11, if anything, I think traders are buying the close of 11 more than selling the close of 11. And then 13, 14, 15, probably more traders selling in that area. But again, I think it's really hard to sell the close of 13. It's basically a parabolic wedge. And then buyers below 17, any of these bars in a trading range. Whenever you're in a trading range, it usually becomes the opposite. So you see a big bull bar above the moving average, traders sell it. We see a sell-off and then buying pressure. So in other words, a trend line break, ending of the micro channel, and then a big bear bar in 11, traders buy it. We have 17, big bear bar, bulls buy it. Big bear bar, 27, bulls buy it. Bull bar, 31, traders sell it. So all of this in here is pretty much the opposite. And then obviously buy the close 69, buy the close 70, even buy the close 71, but so close to the target. If you're buying the close of 71, I think you have to be really quick to make decisions. Let me just get a sip of water and then I'll look at questions. Question, is bar 11 a second leg trap? Is bar 11? Yeah, it's an implied second leg trap. So we sold off on 8, pulled back on 10, second leg down 11. So yes, that's second leg trap. Do you trade only one ticker every day? Better question, how do you approach each trading day? I primarily trade this chart. And, I'm always looking at the Emini, whether that's the SPY, whether that's the Emini, whether that's the micro. I see it all as one chart, but I am looking at this market mostly. But I pay a lot of attention to Forex, and I occasionally place trades in Forex. So I'm always watching just various markets. And, I'll look around at things like it was kind of interesting watching the Euro today. Euro, we had a strong rally, but a failed breakout of these highs, and then we sold off pretty sharp and started going sideways in here. But for me, there's so much. I think the longer you trade, the more you start to realize there's just so many trades on a 5-minute chart of something like the SPY or the Emini, that you'll find more than enough trades in a given day. Is there any reason behind your analysis only based on normal trading hours and not electronic? Yeah, I look at when I'm, there's many ways you can view this, and there's no wrong answer. I like looking at the 5-minute chart of the E-mini with 81 bars because it's simple. I like the feel of, the market gaps down and bar one's open. It's kind of like the stock market has opened for the day. But there's nothing wrong with taking the E-mini. If I was trading probably a daily chart, I would probably pay more attention to the Globex session because obviously I could keep a stop in and various things like that. But if you're looking here, so here is I have a bar counter for the Globex, but I don't want to have to mess with it. But if I'm watching this chart, we've had a bear channel. We had a strong trend line break here, and we're probably in a trading range. And then we have this big bear bar on the open. And then we got another big bear bar. So what's going on? We're breaking below this trading range. And then we can see it's always in short. So sell the close, sell the close. Doji, so probably going to pull back soon, but still sell the close. Then we get this bar, probably going to go sideways soon. So it's all the same thing. And then we have this big sell-off, but probably minor reversal up. And then we see this break out above the moving average, good for the bulls, but still below the moving average. And then we get this test down, but strong enough breakout above the moving average, probably going to go sideways. And obviously, it's the same thing. We rallied up to the highs of the day, and you can see we tested back into the start of the Globex range. And so for me, I don't think it matters which chart you trade. For me, I like the day only session. Now, if I'm going to trade something, but what about like something like crude oil? So crude oil, obviously, not a day session for the crude oil. So how would I trade it? Well, I'm going to first decide on my time frame, and that goes into this question right here. I'm going to first decide on my time frame, and for me, if I'm trading a 5-minute chart of crude oil, this is what I'm looking at, and it doesn't matter where I start looking at the market. So at this point, we have a rally test of these prior highs, 3 big bear bars. It's probably more sell the close and buy the close for a second leg. And then it's starting to go sideways. So you may get a deep pullback, which means it's sell the close, yes, but it was a strong enough rally. We may have to get all the way up here before we find sellers. And then the bears got a small second leg and then a rally. And then they got consecutive bull bars. And guess what? We went sideways. So anybody that sold here, sold more up here, made money. Anybody that bought here and bought more down here made money. So it's trading range. Why not tick charts? A lot of people like tick charts. Why don't I like tick charts? I don't have anything against a tick chart. My problem with tick charts, again, I'm biased. I've listened to Al through the years. And for me, when I started, Al was kind of the first person I really studied with trading. So my thought was, why don't I just try and mimic Al? And the longer I traded, the more reasons I stuck with time charts is it simplifies things. If I want to look at, for me, if I'm going to trade a Forex market, and I don't have a problem with tick charts, but my one problem I have with tick charts, at least the logic, I know a lot of people like them because obviously as the volume slows down, the bars start to be a little bit slower. But my issue with tick charts is if I'm going to trade Forex, what tick chart do I use? And then if I'm going to trade let's say I want to place a trade, but I don't know. I don't want to look at the market every hour. I want to maybe place a trade and look at it in an hour or two. Well, for me, I can pick any time frame I want. I can go to a 110-minute chart and trade off this. I can go to a 120-minute chart, a 2-hour chart, and trade this. I can just go to a 60-minute chart. If I want to look at gold on a 60-minute chart, here's gold. I don't have to think about tick charts. And that is my issue with tick charts, is what is the right tick chart to use. If I want to look at a higher time frame of the Emini, is it a 2,000 tick chart? Is it a 5,000 tick chart? Is it a 20,000 tick chart? And then if I want to look at gold, is it a 2,000 tick chart? I want to remember which tick chart goes to which chart. I want to be able to just flip through charts. If I want to look at Amazon, I just want to be able to type in Amazon and, click whatever time frame it is. If I want to look at Apple on a 5-minute chart, I just want to type in Apple and see the 5-minute chart. So let's go back to some more questions. But yeah, I think at the end of the day, you have to decide on what works for you. Hey, Brad, can you mention for today which entries would be for a small position size and a regular position size? It depends on how you want to trade. I think a lot of traders, they just trade. A lot of traders like to build up positions. So for me, you look at the market from the standpoint of the day. And I think that's the first thing you do. So it doesn't matter what your position size is. You look at this market and say, okay, what am I going to do today? So here, when the market is, let me get the screen closer to the center. I've got a wide monitor, and I'm so used to having TradeStation over here that I'm always looking in this direction. But anyways, if the market is on bar 3, you're selling. So you can sell and you can trade large. So there's many ways you could take it. Some traders, they sell the close of 3, stop above 1, and they trade a full size position. Other traders say, yeah, 3's good and all, but I don't know. It's either going to be a trading range or a bear trend. So I'd rather sell more at the open if we get there. So some traders trade very small and they put their stop somewhere up here, allow them to sell here, sell more here. And I think a lot of traders do that regularly. So for me, things I did today, I took a number of trades today. But one of the trades I took, I bought a little early. It was a second entry buy, and I didn't think about the fact that we'd get a second leg down from here. So I bought here, and then I scaled in once or twice. So I scaled in more than I would have liked to. But in those kind of situations, had I bought here, it's low in a trading range. It's a second entry buy, so it's not ideal. I'm not going to get out here. So for me, if I'm long and then I see this, I'm long, I scale in a couple times, I see a bar like 36, it's kind of a tipping point. If we get another bear bar, I'll give up. But for me, the Bears have not won yet, which means the Bulls have not lost yet. And I think that's why a lot of traders like to trade smaller than you think, because that way, if you buy, it gives you a little bit more room to think. Now, the problem with that is it's a catch-22 because you have to know when you're wrong. Most traders should just trade always in. So if you're going to trade something like the SPY, which I think most traders should do, is probably the single-handedly best market for most traders to use, especially when they're starting out. They sell the close of 3. Maybe they put a stop above. Maybe they sell the close of 4, put a stop up here, and they just hold. Trade 5 shares. Trade something so small you're just never going to care. And then, you look at this and you say, okay, it's gone down a couple of legs. I'll get out. And what do you do after that? Well, the market's trying to bottom. I know it's going to test up here. So maybe you buy here. Or better yet, if you buy, use a wide stop, but not really ideal. Bulls buying below bars. So for me, if I'm buying, which I think I bought somewhere in here and scaled in, and then I got out somewhere over here. But I do that kind of stuff regularly. So as far as your position size, it really depends on what you are trying to do. What style of trading are you trying to use? I bought small above 61 today here. So bought here. I think that's reasonable. Since it was a trading range day, I made 5 points, but my position was so small that I made very little. First, when I scale in, the position's large. Should I use a wide stop on that? Well, that is the deal there. So when you're scaling in, you're using a wide stop. When you're using a wide stop, your risk is bigger. Most traders, when they scale in, they trade smaller. And that's the problem most traders have is, I think one of the fundamental problems I think that traders have when they're trading micros is it's really easy for, if you've been trading for a long time, to be able to risk a larger percent than they should. In other words, they just, if you take someone like Al and give Al, you know, $10,000 and put it in an account for micros, or put $7,000 in an account to trade micros, he's probably not going to panic. So it's just because he could trade 3 or 4 micros and not be too worried. But if you give a trader, someone starting out, $10,000, $7,000, and say, okay, scale in 2 or 3 times, they're naturally probably going to panic and they're going to risk more for their trading capital than they should. So to me, where I'm getting at is one of the overwhelming problems I think traders have is they still trade too large. If you're going to trade, it's really better if you can choose your position size. So if you can only trade 1 micro, you're at a big hindrance. It's a problem. It's not impossible. Plenty of traders have done very well just trading one position size and slowly increasing that. But it's ideal if you can trade. If you're going to trade micros, I think it's better if you can trade 3 or 4 micros and then start with trading 1 micro. So in other words, if you're comfortable with risking 1 micro, a perfect ideal scenario, I think you should be able to be comfortable risking, 10 points per micro and be able to trade 2 or 3 micros. The problem with that is that's $150 per trade. Now, if you could trade like something like the SPY, then you can trade 4 shares or 5 shares and risk $1. And then your max risk is on that same trade. If you're risking, if you have 3 lots and you're risking 10 points and 5 shares on each lot, your max risk is $15. That's a lot better than $150. So that is the way I would look at it. For me, if I could not comfortably trade 3 micros, 4 micros, I'd be very selective about my trades. In other words, if I could not scale in, I'd be very selective. And most traders should be selective. They buy above bars like 61, buy above bars like 67. But this is a very hard day for not scaling in. Because if you can scale in and use wide stops, it's very forgiving. But the reality is, I think if you can trade the SPY, that's better, or trade Forex. I've talked about that a lot. But the key is trade small. And when you trade small and scale in, a lot of traders, the reality is, I think the longer someone trades, they end up naturally risking less per trade, but they trade more aggressively. So they take more trades than, instead of taking 1 or 2 or 3 trades, they might take 20 trades. And, does that include scaling in? So a lot of traders, what do? They will, I did this over here. I think I bought either the low of 43 or 44, and then I bought more here. I took part off here and then took another. I think I took the rest off, and I bought again on a pullback, bought more here, got out. So I in these kind of days, end up trading a lot more in pieces. If buying 68, where would you trail your stop after 70? So if buying above 68, which I think is a reasonable trade, where would you trail your stop? Well, when I see 70, I'm probably putting a stop below 70, and it's exhaustive and it's late in the day. So for me, if I'm buying here, I'm probably just trailing below every bar. But again, I'm thinking open of the days if within reach. I want to be pretty quick to take profits because it's a trading range day, and trading range days allow traders to make money fading breakouts. Do you ever take profits based on actual risk? Yeah, I do that regularly. If so, could you please show an example when it could be more convenient? Yeah, so let me think through an example. I'm trying to think about, it's not really a great example, but I was long here and actually made a mistake. I took part off and I bought more on a small pullback and then bought more down here. And part of that because I bought a little bit higher and my risk was a little bit more on the way down, I used a wider target. But as far as, for actual risk, a good example, I didn't take this trade. I was long at the time, but I didn't necessarily buy above 36 or 37. But had a trader bought above 37, I think it's reasonable to, kind of like right here. They buy, they have a stop here, they go for 1 times the risk. The longer you trade, the more you just start entering and exiting based on price action now. So you see a rally up to here, it's testing these highs. 39 rallied, testing this breakout point here where bulls got trapped on 32. You can rewind this video, and I talked a lot about 32. The market triggered this limit order and went down quite a bit and then tested the limit order and then reversed. Katie asked, how do you know it's a measuring gap or climactic bar? Do we look for the follow through bar? So every trend bar is a buy climax. Every gap is a buy climax. And the bigger the bar, the more climactic the behavior. So strong trends, I've shown this chart before. I don't want to mess around with pulling up my PowerPoint, but I'm just going to show the chart on TradeStation. So this is an example of a fairly strong breakout. This is a strong breakout. Bull bar, follow through bar, another bar, another bar. It's very orderly. The bars look good. They're not too big. They're not too small. It's not climactic. You look at this breakout and you don't see anything that's just alarmingly too big. In other words, climactic behavior like this convinces traders to exit because it sells off and then pulls back, sells off, pulls back, sells off even bigger. Here, it's another bull bar, and they're pretty orderly. This bar is a little bit climactic, but it still went a little bit higher. Compare that to today. Here, we have a sell off, sell climax, and then a big bar. Big bars generally lead to profit taking. Climactic bars are kind of emotional. So, like right here, let me go back to the actual chart with numbers. Bar 23 is a big bar, but it's a big bar. It's climactic. It's bigger than most of the bars to the left. And when you look at days like today, you can generally fade everything. So you see a big bar like 23, it reverses. You see a big bar like 11, big bear bar, it reverses. 34, bear bar, and then it reverses up. So I don't know if I'm answering your question like you'd want, but how do you know it's a measuring gap versus a climactic bar? I think what you're asking is how do you know it's a measuring gap versus an exhaustion gap? Most gaps on trading ranges are exhaustive. And how do you know that? Well, look at every breakout. What's a breakout? A breakout is when the market goes above a bar or below a bar. most breakouts fail. Here, the market went below 2 and sold off. But look what happened on the high of 24. It tested the breakout point. Here, the market went below 6 and then immediately closed it because traders are buying the 6 low and scaling in lower. Hey Brad, what triggers opening reversals since the open has very little context and the open doesn't care much about the open? Well, the open, it does care a lot. The open, there's many ways you can look at this. So 50% of moves, Al says 50% of moves on the open, which means 50% of the initial, 50% of the time, 50. When you get an initial move, there's a major reversal of that move. Why? That's because 50% of the time, it's a sell vacuum of something. It's really, really important to begin to realize that most breakouts are buy climaxes and sell climaxes. They're buy vacuums and sell vacuums. And you may not be able to see what it is, but that's what they are. Look at this chart today. You see all these big bars, 68, violent bar, and then it rallies to the open and then sells off. So how can you have such a strong rally like 60, this bar, 68, 69, 70, 71, get to the open and then just melt away because you're in a trading range? We had that on the Forex market today. Let me find which one. I think it's actually the euro. Let me go to like a 30-minute chart. We had this strong rally, 3-4 bars, goes up to here. It tests this bar right here, and then it just melts away. How in the world can this happen? That's just so unfair. If I'm buying here and then I get trapped, well, welcome to the world of trading ranges. You get this strong rally here, and then it sells off, and that happens pretty regularly. You can look at, I get the logic, and I know, I get why people ask, why, how can you look at a day only chart because it's missing data? When the market opens, you have this gap, and this gap is missing data. And you're technically right, because the market, there was data on this bar, 81, and then today there's a missing data from here to the open. And you can look at this chart, the market sold off. That's true. And you could argue that, well, if you see the Globex market, then you would have a better idea of what's going on. And that is also true. But you also don't need it. A lot of traders, are going to look at this, and when they see bar 1, 2, and 3, they're going to start selling. They know it's probably a sell vacuum, but they also know it's a sell to close market. So they're going to sell. And when they start to see bull bars and buying pressure near support, and this is just one of the support levels. I mean, if we really want to, if we go to a 15-minute chart, we can find all sorts of support levels. We can take this doji bar right here. That's a support level. This bar, there's a support level. There's all sorts of them. Here's a support level. But you don't ever know which one it's going to be. And it doesn't matter. Here's the low of the 17th, this bull bar right here. But when you look at the low of the 17th, are you going to buy with a limit order after 2 consecutive big bull bars? Probably not. But the bulls that did and scaled in, they made money. So I hope that answers your question. But a reversal is triggered. Most reversals are buy vacuums and sell vacuums of support and resistance. What is the market cycle? It is seeing at the opening range. I'm not quite sure of that question. Does a big bar with the tail mean profit taking? Generally, it means selling. And, it depends on the context. Is it selling? Usually, there's always profit taking when they're selling. So there's always bulls selling out of longs and taking profits when bears are selling to go short. There's always bears buying back shorts when bulls to take profits when bulls are buying to go long. But it depends on the context. Why did this bar 70 happen? Because everybody is agreeing that we're going higher. And if everyone thinks we're going higher, guess what? They start to take profits up here. So for me, if I'm one of those bulls and I'm trying to remember what I did here, I was long. And when 60 started to race up, I was long here and I took part off and took the rest off. And then I bought back the position on 70. I took part off and then I believe I took the rest off. But when this bar, no, that's not actually right. I bought and then I took part off. And then when this bar rallied into the close, I added back on the part I scalped and then extended both of the targets higher because I thought we would test near the open of the day. But this bar is a buy vacuum, and a lot of traders step aside. The bears are giving up, yes, but the bears may be giving up. They may be giving up on the idea of selling the high of 55, but that does not mean they're giving up on the idea of selling the high of 24 or the open of the day. They're just extending, they're just going to sell higher. They look at the momentum of 70 and they say, what a great opportunity to sell 5 or 10 points higher. I'm going to do that. If you sold 4 or 5, would it be for a scalp? I would scalp out. And the reason is whenever you get a micro channel in the open, typically there's going to be a minor reversal, 80% chance there's a minor reversal on the open, which means 80% chance we're going to rally at least and go sideways. 50% chance you'll get a major reversal. Can you show an example of a truncated wedge? I don't know if we have one here. I don't see one at the moment. Maybe here, 45 is a truncated wedge. So we sold off on 27, second leg down to 35, and then the third leg formed a higher low. All a truncated wedge means is the third leg down. There were so many buyers. So everybody sees the wedge, 27 and 35. Everybody sees the wedge here. And what they do is they look at the wedge and they say, yeah, it's a wedge bottom, but there's probably buyers down here. So what do? There's so many bulls buying that they're worried it's not going to get below the 35 low. So they start buying before it gets there. And in trading ranges, that happens all the time. Do you always enter and exit on a 5-minute chart, or do you use lower time frames to exit? Sometimes I'll use lower time frames. I didn't today. I really try and, refrain. I really try and just use whatever chart I'm looking at. So if it's a 5-minute chart, I really want to focus on the 5-minute because it's just so easy to mess up. It's so easy to get, if you're looking at a 1-minute chart, then you start looking at 2-minute charts. You start every piece of information you start looking at is one more variable to give yourself analysis paralysis and freeze up and not do the right thing. When looking to the left, are bars high? When looking on a chart, I'm trying to understand let me just read the question for a second. Okay, is the high of the bar and low of the bar more important than the close? For example, bar 23. You mentioned close of bar 23. Why not the high of the bar? Yeah, I mentioned, so the close of the bar is, the reason I say that is because on a line chart, I think that's what a lot of traders look at. So if we look at by the way, what happened here on this chart? Obvious support. Well, I've already talked about that, but there's the rally. We had a sell back and we broke below it and we reversed up. We also had a bull bar here. That bull bar is kind of like this bull bar 6. Remember what I said on 6? The midpoint of the bar. That will be a resistance level later on, and it'll be a magnet. So the reason I said that was because This is a magnet. The middle of this bar is a magnet, just like this low is a magnet. So we're getting vacuumed up to this area. But anyways, back to the task at hand, and that is to bring up a line chart of the 5-minute chart. So why does a line chart matter? A line chart represents the close of a bar. And when we look here, you asked me about bar 23. Here is bar 23. 23, the close of this bar is 29.50. If we go to a 5-minute chart, the close of this bar is let me see here. Oh, this is the ES. Let me 11.25. That's right. Let me see something here. So 29.5. That's very odd. Maybe I'm tired and missing something here, but 29.5. I just want to see something really quick. That is interesting. For whatever reason, this chart is. Anyways, I don't know why it's showing a different price there, but I'm sure that's a me error more than TradeStation. But bar 23 is the high of this bar, 11.25, and the close is 29.50. And when we look at this bar, when we look at a line chart, we only see the high close. And a lot of traders, they look at line charts. That's all they care about, support and resistance. And it doesn't matter. We can look at anything on a line chart. And I think that's how a lot of traders look at the market. If they're looking at, just turn on CNBC. And we've all heard Al say it. They're not talking about candlesticks. They're talking about line charts. So here, euro dollar, we've been in a bear trend since somewhere over here. And we're clearly holding above the moving average, making higher lows, lower highs, and lower lows. Dollar franc, broad bull channel. So anyways, that is the whole point behind looking at closes. And often the close is just you could argue it's a more important number. But there are 4 variables to a candlestick. There's the high, the low, and the open and the close. Okay, the price action with bar 37 and 46 and 61 and 67 are the same. So 37, this bar, 46, this bar, 61, this bar. Yeah, they're bull bars closing on their highs, but the context is subtly different. Is the resumption of a second leg trap a trading range? Most second leg traps lead to trading ranges. So we have a leg 1, pullback, leg 2. This is a second leg trap. Even if we fall below the bottom of the second leg, which could be here, the 19 low, it's probably going to lead to sideways trading. But you can see if you bought here and bought more at the bottom of the second leg, the market came back to it. We have a rally to 52, pullback, and then a new high to 73, second leg trap. Even if we fall below it, guess what? It's probably going to go sideways. What are my thoughts into going into June with the debt ceiling talks? I know Al has said numerous times that he would argue, and then of course this was before 2 days ago, so I got to give him a little credit there. He would say that we're probably going to go to up to the August 19th high, this area, the August rally. We're probably going to get up there. And I agree, we probably will. But if you listen now, the one thing he warned is we may pull back first. So this is the trading range. It was reasonable to buy here. It's reasonable to scale in lower. So we're probably going to go up here. But the reality is we may have to get somewhere down here before we go up there. So to me, when I read your question, what are your thoughts on going into June with the debt ceiling? The what I see is what are your thoughts going into June? Because sure, the debt ceiling, that's important. It could change fundamentals. But when you look at this chart, what are your thoughts? And it's a trading range. We tried to go up several times. We failed. Now we're trying to go down. So what are targets? Well, 4,000, the March 13th high, the midpoint of this rally, the March 13th low. Remember what I said on a daily chart a while back? I mentioned that for those that keep up with the blogs, what did I say about the May 4th high? I've said numerous times. I thought that this rally was strong enough that there would be buyers below May the 1st. And you can see bulls made money buying the low of May the 1st and scaling in lower. But I also said there's probably sellers above May the 4th high. And guess what? We're really close to that May the 4th high. So bears sells, they scale in more anywhere. We're probably going to fall below the May the 4th high. Now, what I don't know is do we have to rally first and then get a second leg down? We could easily rally all the way back to here. But to me, I think we're going sideways. Assume you're in a buy position and the market's going against you. Can you give us some examples that make you believe it's no longer valid? Well, yeah, I mean, there's a couple. I think it can be dangerous buying here. To me, if I'm buying the one low and then I see 4 and 5, I'm probably getting out. And the reason is it's a breakout with follow through. If you thought this was a trading range, now you have a clear breakout with follow through. You're wrong. So here's a trading range open. If you're buying the 17 low or the 10 low or the 1 low, and then you see this bar, you're wrong. So if you're still in, what do? You get out. There might be a bounce, sure, but to me, this bar 40 is strong enough for the second leg. How many bars do you wait at the open and decide what to do? It really depends on day to day. Some days I'm at my computer, ready to trade on bar 1, and I'll wait for a few bars. Other days I start looking at closer to 10 o'clock Central Time, bar 6. But or 9 o'clock Central Time, bar 6. So it really just varies. But in general, I'm looking for a trading range open. So in other words, I'm expecting the market to go sideways for 6 to 12 bars, or I'm looking for a trend from the open. When you get a big gap, I'm generally more hesitant to aggressively sell because I want a test of the moving average. By the way, I'm planning on doing a live Q&A session for a couple of hours on Saturday for those of you that are in the trading room. So if you want to subscribe there, it is at brookspriceaction.com, which most of y'all know. Let me see if I can and there's a way to get a free trial. I believe you just have to sign up and then the person that runs it can grant that. But I believe you go here, brookspriceaction.com, to sign up for the trading room. But anyways, that is all the time I have today. Overall, it'll be interesting to see what we get tomorrow. I think tomorrow is probably going to gap up or rally. So in other words, we have 3 consecutive bear bars if you don't include this bull bar on Monday. So I think there's going to be disappointment going into tomorrow, and that there will probably some buying. So I wouldn't be surprised if we try and rally overnight. All right. Thanks again, everybody, for watching, and we will see what happens tomorrow.